Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canada added nearly 88,000 jobs in May, soaring above an expected 10,000 estimate. Much of that growth came in full-time jobs. Construction led the overall gains, as well as culture, recreation, transport, and warehousing. The unemployment rate fell to 6.6%. That's the lowest level since January. It was expected to hold steady. And shares of Lululemon are trading lower in the pre-market today after the yoga wear maker cut its profit and sales forecast for the year. Lululemon says its performance is being affected by negative commentary in the media and online about its brand. It also says not all of its product launches have met expectations. And the manager of the S&P and Dow Jones indices has closed the door for tech companies like SpaceX to quickly enter the indexes after an IPO. The 12-month so-called seasoning period for newly public companies will not be shortened, nor will it waive existing profitability and public float requirements based on a company's size. SpaceX's denial means it won't be an immediate must-buy for index tracking funds. And we're watching the U.S. futures this morning. Wall Street's historic run poised to come to a bit of a halt today, with stocks and bonds falling after a solid jobs report. You can see the Dow is up ever so slightly, but the Nasdaq and the S&P are down today. And we'll also take a quick look at where the TSX finished yesterday, just above 35,000 points for the day. The S&P is not fast-tracking big IPOs like SpaceX into its indices. It's bringing up questions of whether the rules need to be rewritten. Here to talk about that and more is Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. It's great to have you join us. Thanks so much.
Great to be here, Lindsay.
What do you make of this new kind of regulation, I guess, from some of these indices?
Well, I think it's great news for investors. I think it's good to see that we still have adults in the room when it comes to, the most important benchmark stock index in the world. The fact that we're not going to fast track some of these mega cap companies with IPOs like we're doing with the Nasdaq, I think that's good news for investors. I think it takes away some of the concern, Lindsay, that some would have had that perhaps this was going to lead to distortions in the index, would lead to active and passive managers reallocating to get these new positions into the portfolios, into the indices. So I think it's good news. I think it's a bit of a curveball for some, but I think it's good news at the end of the day.
We're obviously watching for a number of big IPOs, including SpaceX, Anthropic, OpenAI. Is there any one you're watching in particular in terms of how it moves the markets and affects things once that IPO is actually launched?
Well, I think we're going to watch all of them because obviously we have seen situations in the past where a stock has been, very much anticipated. Think back to Facebook in 2012. Only to see the stock really not perform afterwards. So I think there's going to be a ton of focus on SpaceX, a ton of focus on Anthropic. And this comes at a time when the market is starting to lose some momentum. We've seen a massive upsurge in the markets up until this week. And that momentum, if it continues to fade, could actually speak to how successful these IPOs will be when they come through.
Okay, I want to get a broader sense of the markets now in terms of what we're seeing today, but also you say there were two notable cracks this week that might portend to what's in store for us as we wrap up the first half of this year. Explain what you mean by that. What were those two notable cracks that you saw?
Well, I think one crack was the results that we saw from Broadcom in terms of disappointing results for the last quarter. Obviously, the stock is taking a beating in pre-open. And I think it, again, is just a little bit of a warning sign with respect to the AI trade, that this thing cannot continue at this pace forever. It's not to say the AI trade is going to go away, but I think that's one potential crack in the landscape, Lindsay. The other crack was really what we saw in the jobless claims numbers yesterday. Now, of course, we had a report this morning on U.S. jobs that was absolutely fantastic, well beyond economists' expectations, but still pretty much a lagging indicator. The claims data is going to give us a better view to what we expect on the labor market side as we work our way through June, July, and August. And I think that's a potential crack in the labor force. And again, that's a very difficult comment for me to make this morning, obviously after these headlines, but it is something that we need to watch.
Interesting. We saw some results come out over the last couple of days, yesterday in particular, for Broadcom and CrowdStrike, those two companies coming in below estimates. We saw markets reacting to that. I wonder, what is the market sentiment, do you think, right now on AI?
Well, I think generally the market sentiment is still positive. And let's put this into perspective. Even with the pullback that we're seeing in Broadcom right now, Lindsay, this stock is still up more than 42% from the lows that we saw simply weeks ago. So this is still a stock that has been on a tear. And some will actually look at this perhaps as a healthy pullback, that we can't see market continue to run at this pace forever. It's healthy to see these stocks and these markets pull back. And maybe that's all this is. But we're going to have to see other companies come forward to see if this was a one-off or this is more systemic as we work our way through the third quarter.
Right. I was going to ask that, right? Like, I was going to ask if this is a one-off. And I take your point that we need to see more companies and see market reaction to see whether it actually is. But was this just kind of like a bit of a blip in the market rather than more of a correction when it comes to what we're seeing with tech stocks moving forward, do you think?
Hard to say whether it's a blip or not. I think what I would say is that the expectations have been set extremely high, right? And we go through these cycles, let's see, where markets will set the bar low, making sure that we see results that come in that might be exactly what we saw for Broadcom, actually move the markets higher. Today, I would argue the markets are setting this bar extremely high for companies. And therefore, when you get a company like Broadcom, that this really, at the end of the day, if you look at the report, was not a lousy report. It just simply was not what the markets wanted. And the markets are punishing it. And I think every single company that comes out with results that are marginal will probably see this type of reaction by the street. The question mark for us, Lindsay, is whether those reactions accumulate to the point where we actually create a trend for this market that is counter to the trend that we've seen in the last several weeks. So again, I'm not going to go out on the ledge right now and say we've seen the top of this market, but I do think these results are interesting in how market psychology is going to shift in where that expectations bar is set.
Where do you think we're going to see, because you've mentioned that there's a bit of a rotation to non-tech in the market right now. Where else are investors looking, or where do you think is a good place for investors to look?
Well, I mean, for the answer to that question, we just have to look kind of to what's happening in the Middle East. And what is not happening in the Middle East is a resolution to a war that has put considerable strain on supply chains and obviously upward pressure on energy. And I keep going back to this point that back in December, when we were kind of figuring out where do we think the S&P 500 will be or the TSX at the end of 2026, we were dealing with oil prices in the $50 to $60 range, which today, if I were to say that's what we're going to have next week, that would be an extremely bullish comment to make, but that's not the reality. So I think our shift right now is to look at the macro fundamentals, how much inflation and how much demand destruction is going to take place. And I would say the markets today are not fully accounting for that demand destruction.
Before we wrap up here, I wanted to ask you about Lululemon, because we're following that stock pretty closely today. That company, the stock price sinking in the pre-market after cutting its annual forecast. Its latest results are coming out. Not looking exceptionally good for Lululemon. What were your key takeaways so far from what you've heard from that company?
Well, it's kind of like the labor report, Lindsay. This is a lagging indicator, these results. These results are basically showing us what this company was doing under the previous management. Now, that management is gone, right? We have a new CEO coming into Lululemon. And I think what most analysts will tell you this morning is with these results now in place, this company is going to be headed for a major reset under the new leadership. And the jury's going to be out. We're not going to buy Lululemon because of faith. We're going to buy Lululemon if we see new management execute a reset that actually puts this company on a different course. And that's not going to happen tomorrow morning. It's not going to happen next week. But I do think these results do also have to be treated as a lagging indicator for this company in particular.
And Lululemon also said that, the drama that it's seen with its founder, Chip Wilson, weighed on that Q1 earnings report. There is an end to that proxy battle, it seems, between the company and Chip Wilson. Do you think that will improve things as well moving forward, or is that not as big of a factor as the company's saying it is?
I think everything's marginal at this point, Lizzie, right? So every piece of news, every development for this company that is positive at the margin is going to be beneficial to the stock price going forward. And again, it's going to take a while for these marginal incremental developments for the company to start to accumulate to a point where we can say this company is on a different path right now. So again, we'll have to wait and see. I don't think investors are going to rush in, buy this as a massive opportunity, but I think they're going to watch the leadership in terms of what happens. And if if the leadership does not do a reset on this company, the stock price outlook is not going to be great.
Okay. Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Always good to have you join us. Thanks so much.
Great to be here. Thanks.
Coming up, to economists' surprise, Canada added about 90,000 jobs in May, blowing well past expectations. We've got more on that when we come back. Stay with us. Canada added almost 90,000 jobs in May, blowing past economists' expectations and bringing the jobless rate down to 6.6%. Still, May's job growth only partially reverses the loss of 112,000 jobs in the first 4 months of the year. So let's get more from Veronica Clark, economist at Citi, who joins us this morning. Good morning. Thanks so much for joining us.
Yeah, good morning. Thanks for having me.
What's behind the 88,000 new jobs that we saw in May?
Yeah, I think maybe the most important thing to remember is that this is just incredibly volatile data. So yeah, you don't want to read so much into any one month. But yeah, this was much stronger than we were expected. We did see it in full-time employment, which is usually a better indicator of the more stable employment, which is a good sign. But full-time employment and total employment, both of those in level terms are just back to where we were at the beginning of the year. We had a number of much weaker months. The unemployment rate is still in this 6.5% to 7% range that it's been in for a while. So I would really caution reading too much into just this 1 month of data.
I take your point on that, but we'll still look into it as well and just see where we got the jobs numbers from this month. Like, which sectors saw the most strength?
Yeah, it was relatively broad based. It was both goods and services. So maybe there is some recovery in goods, material related sectors. We did see some strength in sectors like food services and accommodation. Of course, at the same time, we also had a really strong employment number in the U.S. I do wonder if maybe there's some early summer hiring. Both countries are experiencing World Cup related demand. Maybe something like that could support sectors like food services, accommodations. So we'll see how the data evolve into the summer, but maybe there's some early summer hiring going on.
Yeah, and then on the flip side, where did we see the most weakness in terms of sectors?
Yeah, I mean, definitely like some of the more trade exposed sectors, you're getting some recovery, but there's still a ways off from where they were, before all the trade uncertainty and developments. So, manufacturing, that's, softer than probably you want it to be. But we do see more recovery there, as those trade uncertainties maybe do start to fade.
When it comes to regions of Canada, it's always interesting to break that down as well. Like, which provinces or territories saw the most gains in the month of May?
Yeah. Ontario, of course, a large province that's had a couple months now of employment gains. British Columbia did also. Again, maybe the strength in sectors like or in regions like Ontario, maybe that is reflecting some kind of recovery from trade developments. But again, it's just a couple months that we've seen gains there, so you do want to take it with some caution.
Yeah, as you say, like this could be some hiring for the World Cup, especially if you're saying we saw most of those gains in Ontario and BC, which is where they're going to be hosted. Okay, so this report also did have some good news for young people in it, though, with the jobless rate falling almost a full percentage point. Is that what you're saying maybe we shouldn't be reading into, or what did we see there?
Yeah, I would be a little bit cautious on that still for now. It is a positive sign for hiring. If youth unemployment is coming down, that's a cohort that has really struggled to find work. This has been a very low hiring, low firing environment for a while, but that really does weigh on, new entrants to the labor force who are looking for jobs for the first time. But yeah, I would caution that, this is May data. It's early in the summer, as we get more students after the end of the school year starting to look for work. There has not necessarily been a broad-based recovery in hiring demand. I watch data like Indeed.com job postings, so new postings for work, and those have started to come down at the end of May. So I'm still a bit cautious that we'll see a sustained recovery there, but it would be a positive sign for new hiring if we did.
I want to talk about the unemployment rate as well and how these gains in jobs maybe impacted the unemployment rate. What have you seen there?
Yeah, I mean, certainly they're related. Of course, we added a lot of jobs, and the unemployment rate came down. We've been stuck in this 6.5 to 7% range for the unemployment rate for a while. We got a little bit above that range, end of last summer or so. But that kind of range, it is higher than what we saw pre-pandemic. It is telling us that the labor market is looser than pre-pandemic. You would probably want to see more sustained pickup in hiring to get that unemployment rate lower. The way the Bank of Canada would be looking at it, that is still an unemployment rate that is correlated with a negative output gap. We're still running activity below potential. But yeah, so we've just been stuck there. If we saw more months like this month, of course, more job gains like this month, I would expect that rate to come down. But it does seem pretty stable in this range that it's been in.
We've seen GDP data showing the Canadian economy contracted slightly in the last 2 quarters. Despite that, many economists have yet to say we're actually in a recession. I wonder, how do these job numbers that we're seeing today kind of play into that debate, do you think?
Yeah, if anything, it does make you a bit more comfortable with the state of the economy after Q1. We had that Q1 contraction in GDP. It looks like Q2 activity will rebound. We had the flash estimate for April GDP showing 0.4% growth. That's a pretty strong month. Maybe May will also be somewhat strong. So we should expect some recovery in growth as we get into Q2. But it is tricky again because we've just seen such extreme volatility in the growth figures and the employment data. So you do have to average through many months and many quarters, and it still seems like the labor market is weaker than you want it to be. The unemployment rate is stuck in that 6.5 to 7% range, and growth is not quite as strong as potential, not quite as strong as the Bank of Canada would maybe want it to be.
Okay, we're gonna have to leave it there. Veronica Clark, economist at Citi. Always great to have you on to break down the numbers. Thank you.
Thank you.
Coming up, the federal government has unveiled an ambitious AI plan, and we'll get into the details on that right after the break. The federal government has unveiled an ambitious plan for the future of artificial intelligence in this country. They're calling it AI for All, and it forecasts massive economic growth, business adoption, and even job creation. But it leaves many questions unanswered, namely around security. CTV's senior political correspondent, Mike LeCouture, breaks down the plan and what's already being said about it.
So this is an AI-driven product.
Artificial intelligence is becoming the norm in a growing number of products and places. It's why the federal government released its strategy to harness the technology while also placing safeguards around it.
That's AI governed by Canadian values. AI that is accountable to Canadians.
The broad goals of the plan are to boost AI use in businesses from 12% today to 60% by the year 2034, to build a world-leading supercomputer in order to increase Canada's sovereign infrastructure in 5 years, and to give all Canadians access to free AI literacy training.
The government will introduce new legislation, regulations, and standards to protect your data, your privacy, your children.
So far, there are no timelines for those safeguards. Experts are also concerned about maintaining our digital sovereignty through Canadian-owned and managed data centers and clouds. And some say the government needs to think bigger than this current plan.
850 megawatts, right? That was the proposed scale by 2030 of the sovereign kind of infrastructure build they're looking at. That's less than 1/50th of what the private sector in the United States is expected to have online in 2 years.
While the federal government wants to build big data centers, Manitoba just denied a project that would have been the size of 260 football fields.
I think we should be skeptical about the hyperscale data centers that are being pitched in a lot of jurisdictions, just from an economic perspective.
There's also a broader concern over how AI could affect jobs in this country.
We know that AI targets those jobs, particularly of young people, the ones that are getting into the market. So we've got to make sure that we give them the tools required to overcome that.
Minister of Artificial Intelligence Evan Solomon pointed to a Bank of Canada study on the impact of AI, underlining it hadn't seen any significant impact on job losses yet. But the bank also notes that could change once AI use accelerates across this country. Vashi.
Canada is officially now in high-level talks with the U.S. on the future of trade between our two countries, but federal officials aren't the only negotiators making their way to Washington. Several provinces have their own trade offices in the U.S. Capitol. CTV's Abigail Beeman now on what, if any, impact the provinces are having.
When half a dozen Manitobans met with U.S. officials to talk trade this week, it was a first in history.
Manitoba produces about 8.5 million pigs every year. 3 million of those are exported live into the United States. Those exports are at risk if we don't have the protection of the trade agreement.
They signal that even though the president signed the agreement 6 years ago, he's not attached to it. So there are some irritants that need to be worked out.
Manitoba is the newest province with an office at the Canadian Embassy. Ontario and Alberta have had theirs for 1 and 2+ decades. But in this trade war, the 4 provinces in D.C. meet bi-weekly around this table. Ontario's representative says it's been effective.
We hope that helps our federal government on things like doing trade agreements, because so many of the things that are in the American interest really rely with our the domain of the provinces.
One of the things I do is like to show them oil sands.
The reps spend a lot of time scene setting to Americans. Alberta's brings this sample to meetings. Nathan Cooper says the issue of Alberta separatism hasn't played a significant role in talks.
On occasion, I'll hear from members of Congress, more so out of an interest of like what's actually happening there. But it very quickly moves on to the key issues that we all face together, which is largely energy and agriculture.
President Trump's back on his high horse, saying we're going to be a 51st state. I can tell President Trump that will never, ever happen.
Asked if some of Doug Ford's comments make his job harder on Capitol Hill, David Patterson says he's met with 150 Republican lawmakers and has not had a bad meeting yet. He's optimistic about a CUSMA deal, but not by July 1st.
If the United States is willing to do it, I hope they are, because I think it's in their self-interest. And so let's get it done by Labor Day.
Ontario's premier visits Washington next week. Alberta is focused on hosting U.S. lawmakers at the Calgary Stampede and beyond. Quebec didn't get back to us. Abigail Beeman, CTV News, Washington.
Stay with us. The opening bells are next. Here are the opening bells at the NASDAQ. Liftoff is ringing the opening bell this morning. On the New York Stock Exchange, AstraZeneca is ringing the opening bell. And on the TSX, Rua Gold to open the market to celebrate the company's graduation to the TSX. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we are going to check in on the equity markets. We'll take a look at the North American markets to start the day. The TSX, after seeing some gains yesterday, down so far today. Same with the S&P 500 and the NASDAQ. This coming after relatively strong jobs reports for both Canada and the U.S. coming out this morning. So we'll watch to see how markets continue to react to that, as well as other news throughout the day, including geopolitical news, of course. Specifically what's happening in the Middle East. We're watching that as well. The potential for maybe some peace talks between, some progress on peace talks between the U.S. and Iran. So we'll keep watching that for you. When it comes to companies on the TSX that we're watching today, Lululemon is one we're watching closely because shares are falling this morning. Particularly, they were in the pre-market after the company cut its full-year net revenue guidance. Q1 EPS did come in line with estimates, while sales beat, but the current quarter outlook is well below expectations. So Lululemon falling as much as 12% in the pre-market. We'll keep watching that. We're also watching Orla Mining. Orla Mining has announced operations have resumed at its Camino Rojo mine in Mexico after a work stoppage there of late. But you can see Orla Mining is down almost 2% to start the day. And for movers south of the border, we are now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, it's great to have you. Good morning. We're going to start with fintech company Circle, which is falling after some price targets were cut over fears of increased competition from MasterCard. Is that right?
That's right. Yeah, really interesting case here. What we have is Mizuho Securities cutting the price target on Circle to $85 from $135. So that's a pretty hefty cut. But the reason behind it is somewhat interesting. Earlier this week, MasterCard came out and said that it was going to expand its card settlement programs to include stablecoins. That move to include stablecoins is really cutting into, or potentially could start cutting into, Circle's business. That is one of the things that Circle is able to do. And now, with a major established player moving into the market and doing that, it's also, MasterCard, I will also say, is also going to do intraday and weekend settlement of its cards. That Mizuho Securities sees that potentially eating up a little bit of the market share for Circle, and that is the reason for the price target cut. As well, we're seeing the shares under a little bit of pressure so far today. It's not a major move, but 2.3%. The stock is moving lower, so worth keeping an eye on over the course of the trading today. Trading day today. And, this whole move towards stablecoins by some of the established credit card companies is an interesting one and worth watching going forward.
For sure. Sorry, I didn't mean to interrupt you there. We will be watching that moving forward. You're also watching Coinbase today. It is falling as Baird names a new bearish pick on crypto volumes. What's going on there?
Yeah, Baird is turning quite bearish on Coinbase, cutting the price target in this case to $142 from $160. So the reason for the bearish pick here is partly because volumes have just been falling. Cryptocurrencies in general have been under a little bit of pressure, and cryptocurrency trading on Coinbase's kind of trading platform has been falling. Now, Baird says that trading volumes have actually picked up on the trading platform in the month of June, but that may be just related to large volumes of selling. So if the volumes that we're seeing here are more sales, and the crypto market kind of indicates they might be, then it will take a long time for these volume trends to turn around.
Interesting. Okay. Bloomberg's Jeff Morgan joining us as always. Jeff, great to see you. Thanks so much.
Thank you.
Up next, the big story of the day, and that's job reports in Canada and the U.S. that could shape rate decisions and move markets. Stay tuned. OPEC+ ministers gather on June 7th for their first biannual policy meeting since the United Arab Emirates left the alliance last month against a backdrop of extraordinary disruption. While the group is expected to maintain current output plans, investors are paying attention to the UAE's bet for more independence in global oil markets. Bloomberg's Abir Abu Amar reports.
The OPEC+ ministerial meeting on June 7th marks the beginning of a new chapter for the oil producer alliance. After years of pushing against production limits, the United Arab Emirates left the cartel in a surprise move last month. It was the third largest OPEC contributor, accounting for 3% of global crude supply. The exit opens a possibility for the nation to get its money's worth from recent oil field expansions. State energy company ADNOC is on track to raise production capacity to 5 million barrels a day by next year, up from 3 million barrels a day back in 2018. But today, producing more oil is only a part of the equation. The ongoing crisis in the Strait of Hormuz has highlighted that easily getting those barrels to market can no longer be taken for granted. That's why ADNOC is also accelerating an expansion of its Fujairah pipeline, which runs to the Gulf of Oman, bypassing the choke point. The route already carries up to 1.5 million barrels a day and has proved to be a lifeline during the Iran war. By next year, the project will roughly double that capacity. Regional rival Saudi Arabia is also expanding alternative export routes, underscoring a wider Gulf effort to ensure that billions of dollars of production growth translate into profitable exports. It's a new reality that OPEC cannot ignore. No longer just about how much crude can be produced, but how much of it can actually be delivered.
The blockbuster earnings season is behind us, and all eyes are on today's job numbers and what they mean for the next week's critical U.S. Fed meeting. We also have a few stocks to discuss. So joining us now is John Zechner, chairman and founder of J. Zechner Associates. Great to have you join us. Good morning.
Hey, good morning, Lindsay.
Let's get to those numbers first of all, both for Canada and the U.S., seeing more jobs added in the month of May than expected. What do you make of the numbers we saw, and what does this do to set up the next Fed chair meeting next week?
Yeah, no, exceptionally strong in both cases. I mean, Canada reversed that negative number we had last month, and so it was very powerful. And when I saw the headline, I thought, well, is it mostly part-time? And I say, no, it was basically all full-time. So it was a very strong number. I mean, it's always hard to get a month-to-month read in employment numbers because they're pretty volatile. They get revised a lot. So you usually like to look at sort of smooth averages for a couple of months. But it's definitely strong. And the U.S. one, same thing. It just sort of gave you more of the trend just on the ADP numbers and the weekly claims. It's been a resilient economy in the U.S. to just, for sure. And it's sort of a little bit of a no hire, no fire market, too, because we've seen what the layoffs have been in tech and other things, and hiring isn't, particularly robust, but it's staying stable. Now, your bigger point, more important question is what does this do for the, particularly the Fed meeting next week? It was going to be interesting anyway, and this really makes it even and more so because there's no way in the world when you've got an employment number like this and you've had inflation running above trend for a period of time that you really can see a Fed about to cut rates in that type of environment, especially with the higher oil price and the risks we're seeing from the war and everything else. So you got Trump's new guy in there who he said is going to cut rates, and he's going to have a committee that's probably not going to agree with him on that. And it could set up. It is more for central bank nerds like myself who sort of look at history. You could end up with a situation if Warsh wants to cut rates and nobody else or just even move away from the bias to easing that's in there right now. If he wants to move away from that, the rest of the committee doesn't. Would he dissent? If he did that, that would be the first time since the 1930s that a central bank chairman dissented with an opinion. But anyway, that's a little aside. It should be an interesting meeting, no matter how you cut it next week. But it's set the table for more likely that the next move in interest rates is higher rather than lower in the U.S.
That's interesting. I mean, do you think is the same case for the Bank of Canada as well here?
No, I don't think so. And it's a good point, Lindsay, because, we've had strong employment numbers here lately, but I just think the economic risks are tilted a little bit more to the downside in Canada. And our inflation numbers have been a little bit better. I mean, the last ones around, we're actually down to that 2% target. I think we dropped briefly below it. We're less impacted by some of the global, some global inflationary effects because of where we stand with oil. And I just think, when you look at that and when you look at the risk of the renegotiations of the USMCA, that's more downside risk for the economy, especially when you saw another round of tariffs come through this week. So I think that's still tilted to downside. So the best move for the Bank of Canada, just stand pat. If you don't know which way to go in the short term, just stay where you are, and I think that's the most logical outcome.
All right, I want to talk about your strategy right now, your positioning, because we've seen a sharp rally in a few stocks while others have continued to underperform, particularly around the earnings season we're seeing right now. In terms of your strategy, you've lightened up on a couple, including Oracle and Alphabet. Why is that?
You've had a great move in some of these tech stocks, Lindsay. I mean, they were so hated a couple of months ago, and then this bounce we saw in April and May, and somewhat driven by fundamentals and continued spending on AI, and the valuations have gotten quite low. And I just think, this is it's a good trading market, and I just like to lean into these things a little bit because you just see, if they don't deliver, you see what the risks are to the downside. I mean, you look at the Broadcom or the CrowdStrike moves the other day on some of these, numbers which are actually, quite good. So it's, I like to go back and forth on this a little bit. And overall on tech, I mean, tech has really led this advance. There's no doubt about it. And, all the bulls on the market call it with the great earnings growth, like 28% year over year in the S&P 500 in the first quarter. And that was really all driven by technology, which is growing at over 50%. And my worry a little bit is, when the music stops, when it slows down, this is a CapEx driven cycle. And, that capital spending looks like on AI is going to to continue. And I mean, you got that read from Alphabet the other day, the fact that they're going to raise, $80 billion of equity. All that tells you is they're going to keep spending. But when that ultimately stops or at least slows down, I just think there's a lot of risk to the downside on the valuations and the earnings and the growth and the gross margins of the chip companies and a lot else in tech. So I'm getting a little more defensive there. But there are other areas of the market you don't want to run and hide. There are, financials are expensive, but and consumers worry me a little bit. But there are other areas. Industrials look interesting up here. Telecom, obviously, the energy stocks still look pretty good. I think gold still got a good long-term story. So there are other places to go that are maybe going to be a little bit more downside protection and are less volatile.
You've also added some commodity names in particular: Cenovus, Whitecap, Nutrien, Barrick Mining, Torex Gold. So some gold stocks, some mining stocks, Nutrien as well. What's the reasoning behind that?
I just think, the commodity story's in place. I think the U.S. dollar has run up recently. With the war, it's become the sort of the safe haven, the global reserve currency again for a period of time. But that will end, given the the debt levels in the U.S. and everything else. And I mean, that's a tailwind for commodities in general. Obviously, supply-demand dynamics with what's going on in the Gulf and the other geopolitical risks are going to support oil a little bit longer. I think longer than people expect. I think you've talked about that with some other guests too. That you're getting very close to the physical tightening in the physical oil market that'll send prices a little bit higher. Gold, I think central banks continue to diversify and away from fiat currencies, and that's going to support gold prices in and around this range, and the gold stocks on that basis are still very cheap. So, names like that stick out as nice sort of, downside protection plays, and there's still global growth doesn't look bad despite, all the worries in the Gulf, and the higher oil prices we've seen.
Okay, we're going to have to leave it there. John Zechner, chairman and founder of J. Zechner Associates. Always appreciate your time. Thanks so much.
Thanks, Lindsay.
Just ahead, we will continue our coverage of the latest job numbers. Stay with us. That's next. U.S. jobs data remains unchanged for May. So what does that mean in light of rising oil prices? Here to provide in-depth analysis is Ian Wyatt, chief economist at Huntington Commercial Bank. It's great to have you join us. Appreciate your time this morning.
Thank you for having me, Lindsay.
So 172,000 jobs added in the month of May in the U.S. Were these numbers in line with your expectations?
Our expectations were 100, so we were a little higher than estimate, but the estimate was 88. So this was a double. This was a massive beat, honestly, on the jobs numbers. And what's interesting too is it was fairly broad-based job growth. We saw a number of sectors adding jobs, not just the few that we've really been relying on for growth in recent months.
I wonder what that tells you then. Is there an underlying story here about the economy in the U.S. or is it still volatile? Should we be taking these numbers with a grain of salt?
I would say versus if you compare us, where we were 6 months ago to today, there really was a period where we were expecting look, we're up and down every month. It's pretty small. We're going to start hitting the point where year-on-year job growth gets to close to zero. Now, the last 3-4 months, we've really had pretty good numbers, several numbers over 100. You saw the revisions were significant this time. It really does seem like the labor market's firming up. If we look at the turnover survey, you saw openings jumped. So a little bit better openings. Overall turnover is still low, but it's not getting worse in terms of the hiring rate. And, we had things like durable goods orders come in strong this week too. So this fits a bigger picture of a solidifying and stabilizing U.S. economy.
Right. And when it comes to unemployment rate, that was pretty flat. Labor force participation. What's driving those forces there?
Yeah, I mean, it is something where we're seeing even the unemployed rate dip slightly too. So underemployed. So that means people who are part-time but want full-time work, for example. So we are seeing generally a stronger labor market. It was interesting though, if you break down it at a sector level, you do see oil showing up in a few sectors. That jump in oil prices, where did we see drops? We saw airlines, department stores, furniture, some transportation. Those were the weak spots, definitely oil related. Where we saw strength was things like construction. But construction, if you go down into the details, it's very data center heavy. It really is just specialty trade contractors, manufacturing picking up a bit. One other good sign in terms of overall employment was we saw federal employment was flat. It was up 1,000 month on month. And that's really been a big drag on the economy, with the Doge cuts and everything else like there in terms of overall employment growth. So if we get federal flat and you have other sectors really firing pretty strongly, that gets overall growth to a better place. And we're seeing a little bit like temporary help services picked up ever so slightly. And that's a good bellwether in terms of future outlook. We've had some softness for a while in temp help, so seeing temp help do a little better. That was good to see. Metals was really a big driver. Weirdly, fabricated metals, another driver, but it's a lot of that's the data center story. Data centers driving so much of this activity.
Obviously, I don't have to tell you, gasoline prices are up. I wonder how that's affecting like household spending, how that's impacting businesses moving forward, and whether that really plays into the jobs numbers that we're seeing today.
Yeah, so we have already seen some data that we think lower and middle income households have cut back on driving just a tad. We've even saw something today that mass transit systems are seeing a little stronger ridership. So you're seeing a little bit of a response in households, but overall, if you look at it and you do the math, everyone focuses so much on gasoline spend. But the reality is for 80% of Americans, gasoline spend makes up about 4% of their overall spending. Well, it did last year when gasoline prices were low. This year, we think that gets to about 5%. So that's only about a 1% bump. That's really actually a little less than the bump people got from the tax bill this year in terms of their personal income. And, when we talk about inflationary pressures, it's funny, I don't remember people talking about this nearly as much when rents were going up really quickly a few years ago. And the reality is rents in those cases for a lot of households, you're north of a third of their budget. There's I think about a quarter of households where it's 50% of their take-home spend goes to rent. So inflation there is a lot more painful, and this is more manageable, but it's also is when I mentioned things like where did we expect to see consumers pulling back? Because consumers do tend to pull back a little when they're spending more on gasoline. It would be things like department stores, furniture stores. Maybe they're going to trade down, and even at the grocery store, if you look at the historical research, they'll do a lot of beef to chicken, that kind of substitution factor happening, going to generics more.
I know you touched on this in the beginning, but do you think these numbers are going to affect Fed rates in any meaningful way moving forward?
Yeah, I totally agree with our first guest. I don't see a case for cutting right now. I think at the beginning of this year, honestly, we thought there was enough softness in the labor market. And there still is for the lack of hiring really is hurting, new college grads. We are still seeing a lot of new college grads struggling to find jobs. But overall, it's a pretty good labor market. And you have employment, you have inflation above target. You have these things kind of coming together where it's really hard to make a case for cuts right now. And obviously the market's starting price and hike. I don't think we're quite there yet in terms of our forecast that we're going to quite get to a hike this year. But we do see a Fed, and you see it in the messaging. You saw it in the 3 dissents last time that were all wanted a statement that was more balanced. That this is a more neutral Fed, and we certainly have to price in the possibility of hikes this year.
Okay, we'll have to leave it there. Ian Wyatt, chief economist at Huntington Commercial Bank. Really great to get your insight. Thanks for joining us.
Thank you, Lindsay. Appreciate having me.
Thanks. Coming up, we'll tell you how to pick small caps with John Ehrlichman. Stay with us. In a world full of $1 trillion companies, small cap stocks get limited attention, but their under the radar status can create a big opportunity for investors. So how do you pick the winners? BNN Bloomberg contributor John Ehrlichman has a new column on our website about that. John hosts Ticker Take on YouTube, and he joins us now. John, good morning. So what's the secret to small cap success?
Well, we had a good conversation, Lindsay, with a BNN Bloomberg regular, Jordan Zinberg, who has been covering small caps for years. Interestingly, Jordan got started in the industry as a large cap investor like a lot of people, but he did notice there was this sizable opportunity in small caps. And I thought it was a good discussion point because in this bull market, people have gotten used to some eye-popping winners. You mentioned AI. It's not like this happens all the time in the stock market where you can see year-over-year gains of stocks doubling. And more often than not, it actually happens with smaller companies versus larger companies. So we wanted to take a deeper exploration of it. Now, the caveat here is small caps have a history of heartache. They are not easy to pick. They are extremely volatile. They are undercovered, but that's where Jordan sees the opportunity. opportunity because he can get to know management and figure out a game plan. And there are basically 4 things that he's looking for strong small cap performers. He's looking for companies that are proven growth players. They know how to compound, but he's also looking for valuations with that growth that are still justified. He's also looking for management teams that have skin in the game. You know, if they're going to be selling the story of the business, do they have a lot of stock themselves? And if all those 3 things are lining up, if the stock has some good momentum, generally it's the kind of name that he likes.
Okay, so Jordan walked you through 6 small caps that he owns. Those are all in your column on our website. But let's use one stock as an example, and that's Bird Construction. Give us the breakdown on that one.
Well, Bird is kind of interesting because, you know, Jordan will talk to different management teams. And a few years ago, he got keyed into Bird. And it's not normally kind of the area. He's sector agnostic, but this isn't necessarily the kind of company that he would historically think about. You know, you think of projects, big construction projects, how much certainty is there in that? As he looked more at this business, which does a lot of building of everything from hospitals to highways, he actually saw a business that is quite good at ensuring that they have some predictability in their business, number one. And this is a stock that has had an incredible run this year, in part because of the AI boom. BNN Bloomberg's parent company, Bell, actually has been partnering with this business as they look to build out on the data center front. So people got really excited about that. Even after the run-up, though, this is the kind of name that Jordan still likes because they fall into that boat of still delivering on those other things like the compounding effects, too. So a little consideration for small cap investors there.
For sure. Okay, John, thanks so much for that. Appreciate it. You can find John's full story on our website and on the Ticker Take YouTube channel and podcast. Coming up, Lululemon is tumbling today. We'll have details after this. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Canada added more jobs than expected last month. Data from StatsCan shows the labor force added nearly 88,000 jobs in May. That's well above the 10,000 economists were expecting. The agency says the gains were fueled by full-time jobs, with construction leading the overall results. Culture, recreation, transport, and warehousing also contributed to the gains. Meanwhile, the unemployment rate fell to 6.6%. That's the lowest level since January. And shares of First Quantum Minerals are seeing some pressure today. Panama is creating a task force to study the miner's shuttered copper mine. The interagency task force will evaluate the future of the mine. It's the latest move toward a decision on whether the mine can actually be reopened. And shares of Lululemon are trading sharply lower after the yoga wear maker cut its profit and sales forecast for the year. The retailer says its performance is being affected by negative commentary about its brand. It also says not all products launched have met expectations, and the now resolved proxy contest with founder Chip Wilson did not help. We're watching the TSX this morning. It is down by more than a full percentage point. Now it's below 35,000 points, which is where it ended above yesterday on the close. So we'll keep watching that for you today. U.S. markets, we'll take a look at those as well. Strong job numbers coming in from both Canada and the U.S. It seems, though, investors still a little cautious, probably watching what's happening in the Middle East and any progress on those peace talks there. S&P 500 down by more than a full percentage point. The NASDAQ down by almost 2% at the moment. And shares of Lululemon are getting hammered, down more than about 11%, despite beating expectations on earnings after the retailer cut its forward guidance. Now it's down just under 8%. So what's really going on with the brand, and what does it signal for retail and the consumer more broadly? Joining us now is Colin Shazinski, Portfolio Manager and Chief Market Strategist at SIA Wealth Management. Good morning. Thanks for joining us.
Thank you. Good morning.
What do you make of Lulu? It beat earnings, but the stock is down this morning. What do you make of how investors are reacting to what they heard from Lululemon?
Well, there's a couple of things. First, the stock has been struggling for some time. It's been down for much of the year. Its relative strength has been weak, both relative to the overall market and relative to the sector as well. So it's been underperforming for quite some time. So this didn't help. And this is an example in relative strength analysis of why we avoid the kind of companies that are trending downwards are weakening in terms of relative strength. It's often a portent of potentially other bad news to come. And anyways, the point of which is with something like this, that what we're really looking at today is what does it mean for the broader sector and the markets. We're getting to the tail end of earnings season for retailers, and so the question is how much of this is company specific, and how much of this is related to consumer spending in general, and what does this mean relative to all retailers? It sounds like a lot of this is company specific, but at the same time, I mean, we're still going through a situation where inflation has been high. People have had to spend more on things like gasoline and have less money, disposable income to spend on other things, on discretionary goods. So that's quite important as well. And then the flip side of that is, then today we got these absolutely spectacular earnings numbers from Canada and really good earnings numbers from the United States that, on the other hand, say, well, the underlying economy is still pretty robust and the job market's holding up.
Mm-hmm. And I want to talk about that in a moment, but just staying with what we saw with Lululemon, just because we keep seeing this pattern, right? We saw this with Broadcom yesterday or earlier this week, a beat on earnings, but any soft guidance seems to get punished on the stock market. What does that tell you about where we are in the market right now?
It tells us that in the short term, at least, there were parts of the market that are pretty richly valued. We've had massive runs in the tech sector over the last couple of months, and so when you get that, you'll often find situations where people might look for any reason to sell against, to take some profits, basically. And so I think that's what we're seeing this week, particularly on the technology side, is some profit taking after we've had huge runs over the last 2 months. Some of these stocks have doubled in a very short period of time. It doesn't mean it's over. It just means that we're in a by any stretch. It just means that we're in a common correction at the moment. Right now, it looks like we're in a correction within a bull market, and some people are looking for reasons to take some profits. But we'll know this week it's been people taking profits against earnings and a little bit soft guidance. It's only been a few weeks since we had results from a lot of the other chip makers who had still had good guidance, very strong earnings, and their stocks took off. So this is the kind of thing that changes back and forth over time. And this week it's a correction. Another week people might respond more favorably.
And now I wanted to get your look at the economy, because as you mentioned earlier, job numbers coming out today for the U.S. and for Canada stronger than expected on both sides of the border. You touched on it earlier, but what's your take on what we saw today? Should we still expect more volatility, I guess, moving forward?
I think we're going to have a certain amount of volatility as long as the war is going on in Iran, and as long as that's continuing with that related uncertainty. So that's just kind of just sitting underneath everything. And then, but otherwise, this really does tell us that North America, at least, is doing really well. And despite the disagreements over trade, the disagreements over tariffs and all, that we're still seeing, we are getting good, robust growth in a nice turnaround in Canadian employment. And a lot of that can come from resources, because we have seen strength in the oil price, strength in the copper price, strong gold and silver prices. Now, today, we're getting a correction because the U.S. dollar has rallied, but overall, the trend has still been favorable, and these are still quite high prices relative to where they were even a few months ago.
Tech already pulling back this morning when we're going back to the markets now, even after solid earnings. What do you think is behind the nervousness there as well, especially when we're talking about tech? We saw quite a rally recently, now seeing a bit of a pullback.
Yeah, I think that's the catalyst for the pullback has just been that earnings are out. We see this often during earnings season, and it gets more pronounced in technology because it's a higher volatility sector, but we see it across all sectors where at various points in time we will see an earnings report comes out. Is that enough to encourage people to want to continue buying, or will people look at that as a reason for, well, now's the time to take some profits, cut my positions, step back and reassess everything? And so right now we're in this week, it's it's a step back and reassess everything, and we have this correction. As I said about a month ago, everything was soaring on earnings, and so that's kind of also perhaps where we got to the situation where we are now. Is we've run up so much in the last couple of months, whereas say a month ago expectations and valuations were a little bit lower, and then they got pushed up, and that's where we are now. And it could all change again in a few weeks. We're what, 6 weeks to the start of the next earnings season. It goes quickly.
It does really go quick, and you're right. So much can change in so little time. With that in mind, just in our last answer here, what are you liking right now in terms of sectors? What are you maybe staying away from because of all that volatility and uncertainty out there?
Currently, at the moment, we've started to see some rotation back, broadening out. We had a number of weeks where technology dominated everything, and the technology sector surged ahead, and then and everything else was getting left behind. And so what we have seen as part of this, some of the profit taking in technology is we've seen capital flowing back out into other sectors. And that's a good thing, and that's healthy. That means breadth is strong. The TSX hit a new all-time high earlier this week. The U.S. markets have hit new all-time highs some of them have hit within the last week as well. So it's important for us to remember that this is good. The interest in the markets remains high. We are seeing a correction, and that's normal and common. But at the same time, as I said, moving from a concentrated rally to a broad-based rally is really positive for overall equity markets.
Okay, we'll leave it there. Colin Shazinski, Portfolio Manager and Chief Market Strategist at SIA Wealth Management. Thanks so much. Appreciate it.
My pleasure.
Coming up, after months of delay, the federal government has unveiled its AI strategy, which aims to boost jobs and productivity. But will it deliver? We'll take a closer look after the break. Prime Minister Mark Carney's AI for All strategy aims to turn Canada from a research leader into an economic powerhouse in artificial intelligence, with billions in funding, big job targets, and a push to get businesses actually using the technology. For more on what that means and whether it can work, we're joined now by Naeem Ataki, partner and co-leader of the Canadian Artificial Intelligence Group at Gowling WLG. It's great to have you join us. Thanks so much.
Thank you.
So Canada has a strong AI talent and research so far. So why isn't that translated so far into real economic gains? And what's different now with this announcement that we heard yesterday?
I think we have had a lot of strength in terms of, science, research, development. The issue that we have is with adoption. And so this is an issue that is something that the government is looking at squarely with this new strategy. And I would also say that in addition to productivity, which has been, a key focus of the budget, and this strategy also focuses on, is the concept of resilience. And so making sure that governments give the opportunity to our businesses to have choices in who they work with.
Okay, so you say adoption, one of the big issues there. We'll start there. When it comes to Canadian businesses, getting them to actually use AI in their day-to-day operations, what do you think has been holding them back so far?
Well, I would start by saying that the question of trust is something that is important to think about, and it is part of the strategy here. The question is, people have started experimenting with this, but they're not sure that they should go necessarily all in, right? And I think that it is important at this stage to really do that, but you can only do that with two things. One is trust, and the other one is knowledge. And on the question of trust, we see that the government is adding $50 million to its Canadian AI Safety Institute to help with this. And on the question of knowledge, there's this National AI Literacy Initiative in the strategy, which is meant to help not only workers, but also students. And as we all know, there's a lot of questions right now about, people finishing university and how the market is going to look for them. And so it's really trying to look at all stages in order to make sure that people have the relevant knowledge, the appropriate level of trust, so that they can then fully adopt this technology. And there are also obviously a lot of questions with respect to making sure that it is done so in a way that is productive. And we can obviously talk more about that.
Yes, and we will in a moment. But just first of all, because I also wanted to get to the other part of what you said initially, which is Canadian businesses don't have a lot of choices in terms of what they use. Why and how are we going to remedy that in the future?
Well, I think, Canada is an important country in the world, but we need to be mindful of the fact that, there if it depends if I'm deploying technology, if I'm developing AI, or if I'm using AI. If I am using AI, I'm going to want to use the best technology, the one that has been used, the most and the best. If I'm deploying AI, I want to have the opportunity to grow and to scale and hopefully to stay here at home, but also to have a global view and global customers. And so this is where I think the strategy is trying to balance both of these, because obviously it's important to think about the fact that the question of choices is not only with respect to models, but with respect to data centers, with respect to all portions of the AI stack. And I would tell you here that the current political environment is complex. And so it's important to make sure that resilience is part of the story for the government. And this is where they're focusing not just on productivity, but also on resilience. And a key example of this is the $700 million being added with respect to a national AI compute initiative.
Right, because I'm assuming it's pretty important for Canada to reduce reliance on U.S. tech giants. And if you feel that's so, how realistic is that for Canada to actually do that?
Well, that's not my... I would say it's important to see what types of solutions we need for which purposes. Right? And there can be situations where the government or research organizations feel like they want to have, their own data centers or, a Canadian solution, which makes a lot of sense, right? There are a lot of good reasons for that. But we have to think about the economy as a whole. And the economy as a whole also has businesses that are looking not just to be strong in Canada, but also to scale up and, grow abroad. And I think we need to be to have that balance. And so I think the goal here is to add additional choices and to make sure that these choices remain in the future, more than moving away from one to the other. I'm talking here from a business standpoint. Obviously, the Prime Minister Carney yesterday in his allocution made very clear that he's looking from a procurement standpoint, right, to see if we can build. If we can't build, can we partner with various trusted allies around the world? And if not, can we buy? And can we buy in a way that has good economic repercussions for Canada?
And just lastly, the plan that was announced yesterday promises 250,000 new jobs, but we're constantly hearing a narrative that AI eliminates jobs. So how do those two things coexist?
That is a very good question, and I think a question that we're all asking ourselves. I would tell you on this one, the question is, if you don't trust the technology and if you don't know enough about the technology, then the train is going to pass, if I can put it this way. But if you, and this is why I think these are two very important, legs of this strategy, is to make sure that people understand AI and learn about it so that they can apply it in their work. And with this, the goal would be to add for AI to augment what workers are doing as opposed to replacing them. And look, like with any technology, it's important to have the right approach here. The technology is there. It's not like we can stop it, right? So the question is, how do you deal with it in our current, global environment? And also, what can we do to make sure that we do it with the right values, which was another key message that Prime Minister Carney had yesterday. It's not just what we build, right, but how we build it. And what are the strengths that Canada has that are very different that can be different, I should say, from certain other countries, in order to make sure that there's a Canadian flavor, a Canadian ethos to what our AI solutions bring, not just to Canada, but also to the world. And I think this is where we do have a real opportunity. You know, we have a big productivity challenge, this is clear, but that can easily turn into a fantastic AI opportunity for Canada.
Right. Okay, Naeem Antaki, partner and co-leader of the Canadian Artificial Intelligence Group at Gowling WLG. Really appreciate your time. Thanks so much.
Thank you.
And we will have more on Canada's new AI strategy with the Honourable Evan Solomon later today on The Close at 3:30 p.m. Eastern Time. That is 12:30
Great, thank you. I
Pacific.
hope it was okay.
Coming up, will Canada be left with a stronger soccer economy after the World Cup? We're going to take a closer look at that right after this. Canada is set to co-host the FIFA World Cup, a once-in-a-generation opportunity to boost the business of soccer at home. But when the crowds leave and the hype dies down, will Canada be left with a stronger soccer economy overall? On our special series, I looked into whether there will be a lasting economic impact. Take a look.
1, 2, 3, 4, 5, 6, 7.
Playing professional soccer for a women's league here in Canada is something Nikki Small never thought would happen.
When I went to college, my only goal in life was to go pro, and that was looking like overseas or in the States. Like, I never thought I'd come back to Canada.
Now, she's a midfielder for AFC Toronto, playing in a league that's gearing up for its second official season. A season that will continue even throughout the World Cup.
The Northern Super League is taking full advantage of this. We know this is going to pique interest in the game, a game that is already growing so much in this country, but having that extra attention is really important to growth.
Soccer's popularity is growing rapidly in Canada. Even in its inaugural season, NSL President Christina Litz says the league had the third highest attendance in the world for women's soccer.
Great ratings with our broadcast partners, you know, a group of A-plus list corporate partners that supported us this year.
But could hosting the World Cup in Canada give the sport an added boost? Some believe the event could be a financial turning point for Soccer Canada, with the national governing body marking a turnover after years of deficits and projecting a surplus of more than $6 million.
The standpoint of FIFA World Cup comes down to more commercial partnerships. It comes down to more people participating in the game. And it also provides greater opportunity for, even when they look at broadcast rights, they look at more talent coming into the pipelines.
Laura Walczak says participation for soccer in Canada is up and has been increasing year over year. Canadian Tire Jumpstart Charities has been conducting surveys the last 2 seasons, asking 3,000 children and youth across Canada for their sport preference. The data shows half of Canadian youth are now playing soccer, topping swimming and basketball, and well above hockey. And last season, Canada Soccer registered 758,000 people playing the sport across the country. That's still slightly below pre-pandemic levels, but participation rates continue to climb. Compare that to 2023, when Canada Soccer reported 739,000 players registered.
It's more affordable for people to play soccer. It is becoming more inclusive.
According to Jumpstart, the average yearly spending for families with kids in soccer is just over $1,000. That's more costly than a sport like swimming, for example, but more affordable than hockey, where the average spending in a year for a family was more than $3,000. Soccer's popularity has clearly been moving at a pace faster than some of the supports around it. But now, the sport in Canada is starting to see profit also picking up to meet that demand. At Canada Soccer, the CEO, Kevin Blue, says the association has been adding as many different revenue streams as possible. The main ones are now commercial revenue, which makes up one of the biggest pieces of the pie, player registration fees, operations revenue, which spans from coaching to educational services to clinics, as well as government and public support.
Which this year on a revenue budget that will be
just north of 60 million.
But Blue says a bump from a deficit to a surplus this year is less about the World Cup and more to do with revenue from philanthropy, which is apparently catching up to commercial revenue in terms of significance.
Our commercial revenue is healthier. Philanthropy is a relatively new line of business for us that was over $5 million in revenue last year, and we anticipate it continuing to be robust for us as we go forward.
I've worked in philanthropy my whole life, but not knowing exactly what to do on the sports side, I look to the U.S. to see, just because there's so much successful fundraising there among their sports departments and athletic departments. A lot of it has to do with the pride in sports and the alumni.
Samantha Rogers is the VP of Philanthropy at Canada Soccer.
We often attribute that, we see some sports stars that are signing incredibly large salaries, and then so you think that all athletes have money and that all sports have money, but that's not the case at all. Especially as an NSO, we manage the sport from grassroots all the way up to our national team system. I think people naturally just assume that we generate a lot of revenue, but that's not the case.
She says in September, the association launched its Canada Rising campaign to raise $25 million by the end of 2027. And currently, they're at $17 million pledged.
When we say that we're upwards of 17 million, that's because people are pledging to give over a couple of years with us, which is really great for our sustainability. And when we look at investing in philanthropy, it's really around a very modern and progressive way to be able to diversify your revenue stream and really make sure that your organization is set up sustainably for the future.
Rogers says the money will be focused on Canada Soccer's 3 pillars. $10 million will go toward the national team systems, from youth all the way to senior teams. Another 10 will go toward accessibility, providing soccer in schools, as well as financial grants to help families cover the cost of soccer. And the last $5 million will be dedicated to coaching and refereeing.
We are bullish about the long-term trajectory of soccer in Canada. We're also, of course, cognizant of the cyclical nature of men's World Cup years.
Canada Soccer recently also received nearly $10 million from the federal government through its Build Communities Strong Fund. That money will support the planning, design, and pre-construction of Canada Soccer's National Training Centre, a permanent, high-performance home for its national teams. Debate continues around the soccer community on where additional funding should go, especially as we're about to undergo a legacy push from the 2026 World Cup. When it comes to the NSL, Litz feels there needs to be some serious upgrades in infrastructure.
In Canada, we have stadiums that are 3,000 or 30 to 50,000. We really need to look at investing in those mid-size stadiums here in this country if we're going to grow this game significantly. Never mind the fact that there's still a lack of training fields and pitches for community involvement.
Small, meanwhile, has started up her own foundation to focus on the grassroots side of things, breaking down barriers for young people to play soccer for little to no cost. But one thing almost everyone can agree on is this year will be one of the most pivotal moments in Canadian soccer history.
We do think there's a lot of tailwinds with soccer.
And Small says she will be watching.
Just going to bring so much awareness to soccer in Canada and obviously the soccer fans in Canada, and you're just going to see how much Canadians truly love this game.
Coming up, Canadians are buying less alcohol. That's according to a recent report from Statistics Canada. We'll speak with the CEO of an Ontario-based wine and spirit company about how they're navigating this trend when we come back. Canada added nearly 88,000 jobs in May, soaring above an expected 10,000 estimate. Much of that growth came in full-time jobs. Construction led the overall gains, as well as culture, recreation, transport, and warehousing. The unemployment rate fell to 6.6%, which is the lowest level since January. And shares of First Quantum Minerals are seeing some pressure today. Panama is creating a task force to study the miner's shuttered copper mine. The interagency team will evaluate the future of the mine and will analyze a range of issues before making recommendations. This is the latest move toward a decision on whether the mine can actually be reopened. And Donald Trump says the U.S. will spend hundreds of millions of dollars to revitalize the country's coal industry. That money is going to build new power plants, sustain existing operations, and construct an export terminal in California. Trump says the move will bring down the price of energy and the cost of living for all Americans. And we're taking a look at the North American markets this morning, all in the red to start this Friday. The TSX has lost a lot of ground, actually. It's down 1.4% right now. The S&P 500 also down almost a full percentage point, and the NASDAQ as well down almost 2% to start the day. Ontario's alcohol sector is in flux. New retail rules are reshaping where drinks can be sold. U.S. tariffs are reshaping trade dynamics, and Canadians are apparently buying less alcohol. Here to break down the trends and tell us how her company is adapting is Florence Tessereau, President and CEO of Corby Spirit and Wine. It's great to have you in studio, and you brought everything with you, which is great.
Friday.
It's Friday, and we love this.
Yeah.
Okay, so we'll start from about that recent report from Statistics Canada, which shows Canadians are buying less alcohol.
Yep.
How has that trend been? Have you noticed that? Has
Yes.
it been impacting your business?
Yes.
And how have you been trying to adapt?
Yes, so definitely. So thanks a lot for having me. So this is something that obviously we've witnessed. I mean, across alcoholic beverages. I think maybe unpacking that. So you have different categories when you speak about alcoholic beverages. So you have beer, wine, spirits, and an RTD, ready to drink. So we've noticed beer and wine, and then spirits to a smaller extent declining. So it's not a massive decline. It's a slight decline. But then at the same time, we've seen a massive pickup in ready to drink. So RTD, cocktail in a can, which is, I mean, has been proving very well for us. So I think the matter, answering your questions. So what matters to us is where we play and how we win. I think where we play is that we've been quite early into the RTD space, and this is proving very successful for us. And where we win and how we win is gaining market shares in spirits, which is something that we've been delivering consistently over the recent quarters.
What is it that people like about the RTD drinks, the ready?
It's many things actually. I think the first one is convenience, which is the main one. So it's very much drinks on the go. So you can grab that and then you can drink outside. So this is very much this element, which is quite key. I think the quality as well. So many has been discussed about the hard seltzer, but I think the RTD is a different quality, and this is something that the consumer is very much after. And then the other one is the price. So when you were saying that the Canadians are buying less alcohol, it's fair, it's true. But when we ask them the reason why they're buying less, the first reasons they put up front is cost. So that's the first reason, right? By quite mild, to be honest. So I think RTD is offering I guess, a cheaper way to consume alcohol and a good quality one. So this is the main reasons that are coming up front. I think the other one as well, which is quite interesting to unpack, is the portion control. So when you have an RTD like this, so you know how much you're drinking, so you know the sugar content.
Yes.
And I guess in the lifestyle choices that people have those days, this is proving quite convenient and then I guess timely as well.
Good point. Okay, and then the other part of this is in light of the trade war, right? Like a lot of Canadians, we've been seen boycotting U.S. products when it comes to alcohol, given the trade war between Canada and the U.S. Have you noticed that trend showing up, or what have you noticed when it comes to that side of things?
Yes, so as a matter of fact, for the last maybe 18 months, 15 to 18 months, the U.S. products are off the shelf, which has been quite a strong benefit for us because we have a large portfolio of brands, and then we have many iconic Canadian brands, and then we've seen a massive uptick in Canadian whiskey. So I think it's been the opportunity for many consumers to maybe rediscover or discover Canadian whiskey. So we have one brand here, Lot 40. So I guess the growth on Lot 40 has been spectacular. So we've grown more than 100% over the last 12 months, which is, I think, telling. I guess the appeal for the brand, for the taste, but I guess for the pride of being Canadian and then buying Canadian products. So that's very much something which has been positive for us, something that we're continuing. So building into the loyalty. But it's not just in Canadian products that we've seen the appeal. So another one, which is Jameson here. So I've seen a very strong growth. So it's done to the brand as well, and then the work we're doing with it. But I think it's a matter of the consumer shifting his choices from U.S. products into something else, another proposition.
We were already talking about Corby's ready-to-drink cocktails and how you've been seeing a lot of strength in that sector. I think some of them are in the front here, right?
Yes.
So we can show those. But do you expect that trend to continue moving forward, given some of the trends you've been seeing?
Yes, so it's a very key question. So is it structural or is it just a fad? Is it just at the moment? So for us, it's very much structural. So RTD is very much the fourth category. So I was saying you have three main categories in alcoholic beverages, beer, wine, and spirits. And RTD is definitely the fourth one. So it's already 10% of the market. So we are expecting that to stay. Back to the reason that I was mentioning, I guess the convenience, the quality, the cost, the portion control, all that is playing into the category to be sticking around for quite a while, yeah.
We have seen, though, your sales from international markets down 20% over the year. What's behind some of that weakness that you saw?
I think it's down to, I guess it's more in spirits than it is in RTD.
Right.
So it's down to cost. I think it's some of those products are relatively expensive. So I think, and spirits, by definition, it's a discretionary spend. I think the consumers being more stretched with money and then making some choices. I think some of the things that they cut, maybe sometimes spirits. So I think some of that element into the cost pressure that is affecting the consumer, we see that in the sales. And then similarly, we see the uptick in RTD, right? So it's a bit of a give and take.
Right. We've also been hearing a lot from the federal government over the past year now about breaking down interprovincial trade barriers.
Yep.
I wonder if that were to happen, because obviously a lot of those trade barriers are still in place. How would that affect your business? Would it be a positive or a negative for you?
It would be a positive.
Yeah.
So I think we very much welcome that. It's better access for our product to the consumer. It's better access for the Canadian producer. So this is definitely something that we do welcome. So we work quite closely with the authorities to try to make that happen in a responsible and in the good way, but this is definitely a positive for us.
How would it be positive? Like what kinds of changes would you expect to see if there were actually more trade between different provinces and territories in Canada?
I think it's the ability for the consumer, wherever it is, to be having access to. So for instance, we have a winery in Niagara for an affair, and then it's not super easy for someone who's based, for instance, in Vancouver to be buying it, right? So we would make the access much easier, right? So this is, providing better access for products to the consumer. So this is definitely something that we favor.
Here in Ontario, we've seen the Ontario government expanding where you can buy alcoholic beverages over the last couple of years, removing that kind of monopoly that the LCBO had in the past. How has that been affecting your side of the business?
I mean, it's a positive. As a matter of fact, and this is for wine and RTD. This is not the case for spirits. So you can only buy spirits in LCBO stores in Ontario.
Right.
So this is very much wine and RTD. So I guess some of the strengths that we've seen behind specifically RTD has to do as well with the fact that the distribution has expanded. So this is definitely a tailwind behind that. So, you have the ability to be selling to more than 8,000 outlets. So this is a massive expansion. Mm-hmm. So this is definitely something that we're welcoming. And this is something that has been providing a bit of a boost actually to our sales. Having said that, spirits, which is very core to our portfolio, is sold in LCBO, and then still there we're doing very well and gaining market share. So yes, we have an element of the distribution expansions, which is a positive for us, but I guess the fundamentals of the company are very strong. So it's not just a distribution expansion.
Right. Okay, we'll leave it there. I appreciate you coming in and bringing all of this with you. It really gets me excited for the weekend. Thanks so much.
Sure.
That is Florence Tessereau, President and CEO of Corby Spirit and Wine, joining us in studio. Coming up, we've got hot picks coming up next. We'll zero in on 3 picks in the materials sector right after this. Stay with us. It's time now for Hot Picks. Today we are zeroing in on the materials sector, and here to tell us more is Martin Pradier, materials analyst at Veritas Investment. It's great to have you join us. Thanks so much.
Thank you for having me.
So I guess before we get into your actual top picks today, just the materials sector as a whole, where are you seeing the most growth right now?
The most growth I see right now is the copper sector, probably the ones that sector has done better year to date.
Why is that? Because I have noticed the last couple of weeks the price of copper has been rising relatively most days. So what's behind that?
Basically, it's a fear that the U.S. will increase the tariff on copper, and there is now a big price differential between copper in New York versus copper in London. And so the U.S. is attracting all the copper and raising the price for copper worldwide. And is not, and they basically, the inventory of copper around the world is increasing, especially in the U.S.
Okay, so let's get into your top picks then. Wheaton Precious Metals is your first one. You believe this will outperform other gold stocks. Why is that?
Well, one of the things that's been happening is we had inflation, right? And so my two picks for gold that are Wheaton and Franco-Nevada have the advantage that they don't, the cost is relatively fixed. It doesn't go up with inflation. So that's one thing. The other thing on Wheaton is that 40% of the revenue is coming from silver. Silver right now is up 100% compared to silver exactly 1 year ago. That was about $35. While gold is only up 33%. So it has an advantage in terms of year-over-year earnings. It should grow faster. The third thing the other thing about this company is the growth that it has. Nobody has this kind of growth. So for this year, in terms of volume, it should grow 12%. For the next 5 years, it's going to grow 50%. Our best gold miner, that is Agnico, the growth is going to be only 20%. So there is a big differential there.
When it comes to continue.
Yes. The third thing is the valuation. The valuation is extremely cheap. It's 1 to 2 standard deviation in forward PE and for EV/EBITDA. That's the way I look at these stocks. And that means that it has hardly ever traded at this low valuation in the last 5 years. So it's very, very interesting in that sense.
Okay, and when it comes to Wheaton Precious Metals, any risks or headwinds for this company moving forward that you're watching out for?
No. There isn't anything. I mean, at the end of the day, the price of gold is your risk on all the gold stocks. So it moves with the price of gold. So if the war with Iran finishes tomorrow, I think there will be an increase in the price of all the gold stocks. But that's probably your bigger risk.
All right, Franco-Nevada is your second one. I know you already touched on it, but if you want to go into more detail as to why this is your other hot pick for today.
This stock is almost like a free option. So it's trading, again, 1 or 2 standard deviation in terms of P and EV/EBITDA forward compared to the last 5 years. And it has the potential that their earnings can grow about 20-30% if Cobre Panama restart. So Cobre Panama was a mine that was stopped 3-4 years ago. The government of Panama needs that mine to restart. We believe there is like 70-80% probability that the mine will restart. At the time when they stopped the mine, the stock had like a 30% decrease. So if the mine restarts, which we think is very likely, then you could have a 25-30% upside on that.
Lastly, we were talking about copper prices to start off this segment. Hudbay Minerals is your last top pick. Tell us why.
Well, Hudbay Mineral has a couple of advantages. The first one is 40% of the revenue is coming from gold. And this is the reason why the cost is negative. So the cost, for instance, in the last quarter, the cost of Hudbay Mineral was minus 1.80 per pound. So 180 cents negative. On average, the other 10 companies that I follow, the cost is positive 1.46. So this is a big differential. We believe also that because the company is guiding 20 to 40 cents negative for the year, and the first quarter was so strong, and at the end of the year, the volume is going to increase in 2 of their mines, that we're going to see a revision of the estimates, which is always a catalyst for a stock. The third thing is the valuations are 30% below the comparables, the 10 companies we follow. The other thing will be the growth. Almost nobody has this kind of growth. So in 2025, this company will produce 118,000 tons of copper. In 2030, they expect to produce 250,000, and in 2032, they could produce 350. So there are two big projects coming in. Both projects are in the U.S., which has a very low risk. Projects are very easy projects, not complex, high IRR. So that is another advantage. And finally, if you think that the U.S. is going to put tariffs, this company is one that benefits the most. Because what ends happening if you have a tariff, if the price of copper in the world is, let's say, 5, and everybody is coming to the U.S. and then let's say it's a 15%, so you get 575. Because the U.S. is an importer of copper, the internal price in the U.S. will be 575, and this company will sell at 575 and having an advantage because it's producing in the U.S. and has no tariff. So it's a very good place to be if there are tariffs.
All right, we're going to have to leave it there. Martin Pradier, materials analyst at Veritas Investment. Always great to talk to you. Thanks so much.
Thank you.
Coming up, Canada's unemployment rate falls to 6.6%. We'll get into the details of that right after the break. Joining us now with the numbers from Stat Canada's May Labour Force Survey is CTV's Jeremy Sharon. Jeremy, good morning. So what's the Labour Survey's kind of key takeaways in April youth employment?
Yeah, good morning. I mean, this is a surprise good news story. Youth employment was up, as was employment across the board. Unemployment down by 0.3% to 6.6%. That was 6.9 in April. But when you look at the youth job numbers, there are some positive signs for youth and positive signs for students looking to return to jobs in the summer. Youth unemployment across the board down 0.9% to 13.4. The economy added 99,000 jobs in that category alone. Students returning from university or coming out of school looking for summertime jobs. Last year, they struggled in 2025, the worst start to summer job season since 2009. This year, we're seeing a rebound comparatively. Unemployment among students returning to work in that 15 to 24-year-old age group down 2.1%. So that's a positive sign. And again, across the board, we're seeing numbers that are showing some resiliency in the job market. 88,000 jobs added. That makes up for about almost 80% of the 122,000 net jobs that were lost in the first 4 months of the year.
Yeah, sorry, I was going to ask you about that. Some of the other key takeaways from the labor survey that you noticed, Jeremy.
Yeah, I mean, just the fact that we're starting, maybe the start of a new trend or seeing maybe the start of a new trend. I think a lot of economists are going to say, let's wait and let's see what the next, round of numbers are like. But what we've seen so far this year is, slow job losses, nothing significant, nothing that has really stood out until this month. And so this has really caught, I think, many off guard, surpassing expectations. Economists were predicting once again marginal growth, some predicting marginal job losses. Instead, we see a significant uptick in jobs. And the other important factor here is when you break it down into full-time versus part-time jobs. Part-time or full-time jobs, rather, driving this growth in the labor market. We're talking about 154,000 full-time jobs added in May, and then outweighed, of course, by the 66,000 part-time jobs that were lost in the month. So a positive sign that we're seeing an increase, or at least that full-time jobs are driving these numbers.
For sure. Okay, CTV's Jeremy Sharon joining us to break that all down. Jeremy, thanks as always. Appreciate it.
Yeah, anytime.
And that wraps up this edition of The Open. Morning Markets is up next with Roger Peterson. Stay with us.